Of all the economic terms that reflect a critical condition, hyperinflation has proven to be the scariest. While it is true that hyperinflation should be avoided, a lot of people think it is a rare phenomenon and won't affect them in their lifetime. So was the belief in countries that went ahead to experience record-high inflations that are now labeled the worst hyperinflation in history. Now, it appears the U.S. is going down the same road with you in the spinning truck. If you've been asleep on the ride, this video will jack you up. But first, let's see other countries that have had a bumpy financial ride and landed into hyperinflation. Before we begin, please remember to like and subscribe to stay up to date with the latest videos. Weimar Germany. One of the most popular occurrences of hyperinflation was during the Weimar Republic in Germany in the 1920s. Through the First World War, the amount of German paper marks increased by a multiple of 2. By the end of 1923, it had increased by billions. From the outbreak of the war until November 1923, the German central bank issued 92.8 quintillion paper marks. In that period, the value of the German currency fell from about $4 to $1 to $1 trillion to $1. At first, this fiscal stimulus lowered the cost of exports and increased economic growth. By the end of the war, production had collapsed, leading to a shortage of goods, especially food. Because there was excess cash in circulation and few goods, the price of everyday items doubled every 3.7 days until the inflation rate became 20.9% per day. While farmers and others who produced goods were able to survive, others who relied on buying products for sustenance either lived in poverty or left the country. Venezuela. The hyperinflation that happened in Venezuela has to be the most recent. Prices rose 41% in 2013, and by 2018, inflation was at 65,000%. In 2017, the government increased the money supply by 14%. This event only supported a new cryptocurrency called Petro, causing more harm to the country's economy because the bolivar, Venezuela's local currency, lost almost all of its value against the US dollar. Eventually, unemployment rose to over 20%, imitating the U.S. rate during the Great Depression. You may wonder how Venezuela found itself in such an economic mess. Former President Hugo Chavez had instituted price controls for food and medicine, but mandated prices were so low it forced domestic companies out of business. In response, the government paid for imports. In 2014, oil prices plummeted, eroding revenues to the government-owned oil companies. And when the government ran out of cash, it started printing more. As of 2016, Venezuela's foreign debt was about $100 billion. It only got worse in 2020 when the annual inflation rate for consumer prices rose to 2,300%. In the face of unsettled debt, the economy continued to collapse, and the country continued in hyperinflation until 2022. Even though Venezuela is cleared of the crisis now, the scars still remain. Zimbabwe. Between 2004 and 2009, Zimbabwe experienced hyperinflation. This happened after the government printed money to pay for the war in the Congo. In the face of an already collapsing economy, the country experienced droughts and farm produce was confiscated. These further restricted the supply of food and other locally produced goods. As a result, hyperinflation broke in, and it happened to be way worse than what was experienced in Germany. It was a phenomenal one, as the inflation rate was 98% a day, and prices doubled every 24 hours. The crisis finally ended when the country retired its currency and replaced it with a system that used multiple foreign currencies, predominantly the US dollar. After these examples, you may wonder what hyperinflation actually is and what causes it. Hyperinflation occurs when prices rise by at least 50% in 1 month or 1,000% in 1 year. These massive price changes happen very quickly, making common items unaffordable. Although hyperinflation is considered a rare economic phenomenon, it has not been uncommon, and the U.S. seems to be closer to experiencing it than ever before. So, what are the known causes of hyperinflation? From the countries we studied earlier, the major causes of hyperinflation are an increase in the money supply and demand pull inflation. The first happens when a country's government begins printing money to pay for its spending. Therefore, as money supply increases, prices continue to rise as in regular inflation. The other cause, demand pull inflation, occurs when demand exceeds supply, making prices rise. This can happen due to increased consumer spending, a growing economy, a sudden rise in exports, or more government spending. In 2022, it was said that the U.S. had experienced a high inflation. The U.S. Bureau of Labor Statistics measures inflation through the Consumer Price Index. This helps to track price changes for over 100,000 goods and services. The most recent BLS data shows that inflation has risen 7.7% between October 2021 and October 2022. Some of the biggest contributors to elevated inflation in the U.S. include rent, energy, and food prices. For instance, the shelter index rose 6.9%, while food spiked 10.9%. Energy was the biggest culprit, however, soaring 17.6% in 12 months. So, with these figures, is the U.S. really headed for hyperinflation? While a lot of alarm is being raised about the state of the United States economy, it is important to remember that low, stable levels of inflation are healthy and arguably even necessary in a growing economy. In the U.S., the Federal Reserve sets its annual inflation targets around 2%. And though the 7.7% inflation experienced in 2022 is high, experts don't see the U.S. experiencing hyperinflation just yet. The first reason being that the U.S. is experiencing nowhere near the 50% per month inflationary threshold. Secondly, inflation doesn't occur without warning. When the government sees inflation on the rise, the Federal Reserve and central government step in with political or monetary tools to head it off, thereby not giving it a chance to sprout. Thirdly, because the U.S. Federal Reserve is separate from partisan political bodies, the Fed can operate independently of the federal government. That means the U.S. is not susceptible to the hyperinflation that often plagues repressive or dictatorial regimes. Now that we know that the U.S. is only experiencing a high inflation, let's see how it can be handled even when it's not hyper. Although it is unlikely that the U.S. is going off the cliff to hyperinflation anytime soon, it still doesn't mean that you shouldn't make plans for even moderate inflation impacts. If you will stay above rising prices, the best step is to make smart asset allocation and diversification decisions. Many investors turn to assets that they believe will outperform during high inflation, such as material goods. Commodities and real estate make popular choices because, as an investor, their price growth can benefit you. And of course, taking advantage of high-yield savings accounts means that any money you need relatively soon isn't eroded as quickly. Perhaps the most important tip is to stay invested, even if it means moving money around. The alternative is allowing inflation to snack on your depreciating dollars. Over the years, it has been discovered that knowing the negative consequences of an action can help prevent people from taking that action. If the U.S. will prevent hyperinflation, we must know its effects. When hyperinflation is in action, consumer behavior adjusts. To keep from paying more for goods tomorrow, people begin hoarding today. That stockpiling creates shortages. Hoarding can start with durable goods, such as automobiles and washing machines. If hyperinflation continues, people hoard perishable goods like bread and milk. These daily supplies become scarce and more expensive, and the economy falls apart. Also, people lose their savings as cash loses its value. For that reason, the elderly are often the most vulnerable to hyperinflation. Soon, banks and lenders go bankrupt because their loans lose value, and they run out of cash as people stop making deposits. Even though hyperinflation is a devastating economic state, two sets of people are still considered winners in the crisis. The first beneficiaries are those who took out loans and discovered that the collapsing value of the currency makes their debt worthless by comparison until it is virtually wiped out. Exporters are also winners because the falling value of the local currency makes exports cheaper compared to foreign competitors. Additionally, exporters receive hard foreign currency, which increases in value as the local currency falls. In spite of the rarity of hyperinflation, many people are still worried about it. So if it were to happen, what should you do? There are a couple of ways you can protect yourself from hyperinflation. First, be prepared by having your assets well diversified. You should balance your assets among U.S. stock and bonds, international stocks and bonds, gold and other hard assets, and real estate. Second, keep your passport current. You may need it if hyperinflation in your country makes the standard of living intolerable. Hyperinflation is better prevented than treated, because its effects linger on even after it has been resolved. Please subscribe to this channel for updates and like this video if you haven't. See you in the comments.